What's up, money masters, you legends? I'm back for a new video. I see my dog, my vicious attack animal, is making, how's it, boy? He's making a guest appearance today. Today we are jumping into stream 3 and we are talking about low risk investments. If you haven't followed my previous videos, we have been working and building up to this point. But you can also just jump in here and see what low risk investments are all about, and I'll give you some examples of those. Let's get into it. Let's rock and roll. Yes, I've got a new shirt on. Thanks for noticing. In my attempt to keep this video short, I've had to re-record it several times for your benefit, so that you don't have to sit through a half an hour video on low risk investments, but all for your benefit, you money master. Okay, low risk investments, what do I mean by that? These are investments where the probability of losing the money that you've invested is extremely low, and in addition to that, the probability that you will get less money back than what you've saved and invested is also extremely low. So this type of low risk investment is something that gives you a lot of clarity on what you can expect. It gives you a lot of comfort about not losing your money, as well as comfort that you won't get back less than what you put in. That is not a guarantee. But most of the products I'm going to discuss with you today, the probability of getting that package from a low risk investment is very high. Now, when should you consider these low risk investments? And again, I'm going to get back to something I've said in several other videos. You have your own personal risk profile, and part of that is answering the question, what am I saving for? And that will help you to understand how long can I save and invest before I need the money back. That period is called your investment time horizon, and we can break this up like so. If you need your money back in about the next 3 years, this is bucket 1. If you start investing and you need the money back only in about 4 to 9 years time, bucket 2. And bucket 3, if you have 10 or more years to save and invest before you need the money back, you fall into bucket 3. But we have gray areas. These gray areas, what does it mean? You must make that call yourself. It doesn't mean that if you've got 3.5 years before you need your money back, that you fall into this next bucket number 2 and the police are going to knock on your door and drones are going to hover over your house. Why didn't you take other types of risk? You've got 3.5 years, you're in another bucket. It doesn't work like that. We've got these gray areas. And we today are going to focus on bucket number 1, which I would suggest is your low risk bucket. If you need your money back in the next round about approximately 3 years, you should seriously consider taking low risk with your investments, because 3 years in the investment industry is what we call short term. A lot of things can happen. So you want more stability, more clarity, and more comfort that you know what's going to happen with your money if you've got a shorter time horizon. You are welcome to take high risk. Even if you've got like up to 3 years, you're welcome to do that. Just don't cry when you get back less than what you've put in, because high risk doesn't guarantee high return. It can also go the other way. Okay, but for this first bucket that you see here, I would suggest low risk investments. And there are many of these things available, many low risk investments, but I will today only focus on my best 3 suggestions that I think you can consider if you fall into that bucket, or if you want to take low risk with your savings and investments. Three of them, the first two are money market funds and income funds. Both of these are unit trusts, also called mutual funds. If you do not understand what a unit trust or mutual fund is, I made a video called What is a Unit Trust? Please check that out. It will help you understand how this product works. So money market funds, they're allowed to invest in cash, which is not the same cash that you and I always understand. It's not sticking your money in your card into ATM and cash and bank notes come out. No. In investment markets, the appointed investment manager that manages this unit trust, they're allowed to buy financial instruments. Okay, so investments, and make investments that pay interest almost all the time. They pay interest, and that instrument they buy has got what call it an expiration date. We call it in investments a maturity date of less than a year. That is what is called cash in investments. And these income funds, they can invest in the same instruments, or they can make the same investments, but they are allowed to take on a little bit more risk. So they may, as an example, buy some instruments that's got a maturity date of, let's say, 14 months or 16 months, 18 months, perhaps even a 24-month expiration or maturity date. So an income fund is allowed to take a little bit more risk than a money market fund. And what have we learned so far? If you take a bit more risk, hopefully you will get some better returns. So what do these returns look like? Now, before I show you that, this is my best guess. It's not guaranteed by me or anybody else. And it is based on when I made this video, which is the beginning of 2023. If you're watching it 5 years from now, these returns can and will, I would almost say, definitely look different. Why? Because these, the money market fund and the income funds invest in interest-paying, interest-bearing instruments, which is linked to interest rates. Interest rates have been increasing globally for the last 18 months. But when interest rates start going down at some point in the future, the returns will get lower for this type of investment. But at the moment, my best guess for these type of funds, the money market fund, I would say about 7 to 8%, and the income fund 7 to 10%. Why is this the same? Because if this little plus doesn't work out well, then you're not going to get up to 10. And 10 could be a little bit on the high side, but that's a nice way to think about what you can expect from these funds. Now, the third option, I mentioned my best 3 options. My third option that I would also consider in the low risk bucket is the low equity balanced fund, or sometimes referred to as multi-asset fund. This type of unit trust, yes, it is also a unit trust. This type of unit trust has a very specific limit to what the equity exposure can be in this product. Equity exposure, so the appointed investment manager is allowed to buy shares or stocks that trade on the stock exchange, but limited to how much of the fund will be exposed to those shares. And usually that limit is 20% or less. Okay, 20% or less. And the remaining assets, the 80% that's left, will be invested again in the same type of instruments that you'll find in the money market fund, an income fund, with a bit of a sprinkling, some unicorn dust and other similar type lower risk investments. Okay, and now the question is, how and when should you consider using these 3 products that I mentioned, which is my best recommendation for low risk investments? I will show you how I would use them, and you can decide for yourself how much risk you want to take on and how important is the stability and the security and comfort for you. Okay, so if we look at our 3-year bucket and we blow that up like this, if I wanted my money back in the next 18 months, that's a year and a half, I would go 100% all in, only money market. If I can need my money back up to about 2 years from when I start investing, I would consider both money market and income funds. And the closer I get to around about 2 years, the more exposure I have to the income fund. So if I fall in this area, I would personally go probably 80% income, 20% money market, something like that. And if I need my money back about 3 to 4 years from now, 3 years, 4 years, I would only consider the income fund, and I would also have exposure to a low equity balance fund. Again, all up to you. How much risk can you take? How much certainty do you need? But I would probably, if I fall in this area here, I would even go 50% income, 50% low equity for me. That's what I would consider. Now, I have 2 final warnings for you that's got nothing to do with the quality of these investments or the stability that they give you or the risk of the investments that you make. There is something that you need to be aware of. I'm not sure exactly in other countries, but in South Africa, we've got other laws that sometimes influence us that we are not aware of, like banking laws. So for the unit trusts in South Africa, we have this thing that if you are saving via allowing your investment platform to deduct the money from your bank account, which is called a debit order, we can dispute a debit order up to, I think it's about 35 days after the debit order has been taken from our bank account. And we can even cancel that debit order. So, for these unit trusts, the first warning is that last 1 or 2 debit orders, if I wanted my money back at the end of June, but my last investment or debit order went off on 1 June, I won't be able to get this debit order back at the end of the month. That debit order will have to stay with or inside the investment, go through the period, which is more a banking issue. It will have to go through the 35-day period before I can get that back. So just keep that in mind. And then returns. Yes, these low-risk products give you stability, but they give you lower returns. To get the benefit of this more certainty, you have to, the counter to that is the returns you're going to receive. And I'd say the biggest risk is if you're saving, let's say for a fancy, nice holiday at the end of 3 years, and you can get, let's call it 7% return from your money market or income fund. If the price of that holiday goes up by more than 7% per year, so you wanted, let's say by the end of this time, you wanted to have saved, I don't know, $30,000. And that would be the cost of the holiday. But by the end of this period, the holiday has increased in price to $35,000. Then you have too little and you've saved too little to go on that holiday. So I would always be, I'd say, conservative and try and save and invest more than what you think you'll need. It's as easy as that. Okay. Thank you for sticking with me to the end. You legend, Money Master, you. Remember, if this video helped you, I would appreciate it if you hit that like button, or you can subscribe to the channel wherever you see this icon. You can also follow me on Twitter at MoneyMasterSJ on Twitter. And in the next video, I am going to go to bucket number 2, which is going to be more of a medium risk bucket. And I look forward to seeing you in that video. Cheers.